Hello, today is Wednesday, January 20th, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Wilms, and I am the president and CEO of the Milwaukee Company, and joining me today is Dan Dumjic. Dan is a principal in Taxable Fixed Income at Piper Sandler Company, which was formerly known as Piper Jaffray. Dan's responsibilities include mortgage-backed securities trading and strategies related to fixed income. Dan's earned his bachelor's degree in finance from the University of Wisconsin-Madison and an MBA from Marquette University in Milwaukee, Wisconsin. He is a certified financial analyst, a certified financial planner, a financial risk manager, and a charter market technician. So, Dan, I think it's fair to say that you have more initials after your name than anybody else I've ever had the pleasure of meeting.
Well, Andy, thank you very much for having me on this podcast. I look forward to hopefully being informative session for your listeners.
I'm sure it will be. And before we get started, allow me just to remind our listeners that this podcast is for informational purposes only, and listeners should conduct their own independent research before acting on any information or opinions expressed during the podcast. And that the views expressed today are those of Dan and my personal views, and not those of the Milwaukee Company or Piper Sandler. So with that technicals out of the way, Dan, let's get started. And I thought maybe we could just begin by a general introduction. What are your thoughts about the fixed income market at the moment?
Well, Andy, that's a great question. The fixed income market right now is really experiencing something we haven't seen in decades. Historically low interest rates. And I'm using the U.S. Treasury market to define kind of fixed income generically in here, but 10-year Treasury rates for most of the past year were below 1%. And now with the potential for additional stimulus in the trillions of dollars by the U.S. government, the 10-year Treasury has started to increase to now where it's over 1%. So there is some concern about inflation down the road, and hopefully our listeners are aware that inflation erodes fixed income cash flows, and that is something that I think is going to affect the fixed income market going forward. So I do think that while interest rates have been falling since the pandemic started in the spring of 2020, they've been rising here recently, and the concern for inflation going forward is something that is real. And the market is starting to price that in, and clients will be looking for diversification in other types of securities that may give them some protection from inflation if it increases here in the upcoming year.
Well, Dan, I know you spend a lot of time working with mortgage-backed securities. Are they a possible source of diversification in the current market?
I believe they are, and we're going to talk about specifics on why that is the case. But I think mortgage securities really will come, I think, an important part of portfolios, diversified portfolios going forward, as clients become more fearful about the increased leverage of U.S. corporations and credit risk associated with corporate bonds, potential for municipal securities, again, to experience some risk as municipalities' tax bases get strained in here. And I think mortgage-backed securities will just be another component in the overall diversification of investment portfolios.
Well, just for those who aren't the uninitiated that might be listening, maybe you could give us a very brief overview of what exactly mortgage-backed securities are and who issues them.
Absolutely. I'll start off with kind of a macro point here that I think really tells you how large this market is. The MBS market now totals $10 trillion in total, and that's second only to Treasuries, which are around $22 trillion. So just keep that in mind at how large this market is. Essentially, mortgage-backed securities were created by Fannie Mae, which is a government-sponsored enterprise that still exists today, in 1968, but really came into widespread prominence in the late 70s. And it allowed investors to participate in the housing finance market without having to buy and sell individual mortgage loans. So mortgage-backed securities are really groups of home mortgages that are sold by issuing banks, and then they're packaged together into pools and sold as a single security. This process, it's important to note, is called securitization. So getting a little more granular here, and I'll try to keep it brief, is mortgage securities are backed generally by 15-year and 30-year mortgage loans, which banks and other mortgage originators sell to these government-sponsored enterprises such as Fannie Mae, Freddie Mac, and Ginnie Mae. The basics behind that process is that homeowners who have mortgage loans make principal and interest payments to a bank who forwards those payments to Fannie Mae, Freddie Mac, and Ginnie Mae, who then keep a portion of these payments called a guarantee fee, and this is important, and finally forward the remaining balance to end investors. Now that sounds like a mouthful, but here's the key point. The near government entities, government-sponsored enterprises, Fannie Mae and Freddie Mac, they guarantee the timely payment of principal and interest to the investor, regardless of the credit worthiness of the underlying borrower in the security. So even if that underlying borrower were to default, Fannie Mae, Freddie Mac, and Ginnie Mae guarantee that principal and interest payment to the investor.
Well, that's an excellent point. I think it's important to recognize, too, that there are some private companies that also issue mortgage-backed securities, I think, which are known as private label mortgage securities, but their credit ratings tend to be much lower than the securities issued by the government agencies because those don't carry the full faith and credit of the U.S. government. So if I'm not mistaken, I believe your preference is to stick with the mortgage-backed securities that are federally guaranteed. Is that true?
It is, especially for the high net worth individual or retail investor that's really looking for high credit quality type instruments. I would say, to answer your question, the non-agency mortgage-backed security sector is really geared more toward institutional investors, though we have in some cases where if a retail investor or high net worth individual is qualified enough, we can sell them those type of securities. But I think the focus for your listeners here today is on the government-sponsored enterprise guarantee by Fannie Mae, Freddie Mac, and Ginnie Mae.
Yeah, I would agree. I mean, the private companies, that's really the private label mortgage security. That's really for a more sophisticated investor who can really, do the groundwork that really needs to be done before you can take on the additional risk that they represent. So, but let me ask you this: how do mortgage-backed securities compare to traditional bonds?
Well, that's a great question. Also, it's a very commonly asked question. Just to give you some perspective, your traditional bond, fixed coupon bond, let's say a U.S. Treasury bond, they carry a semi-annual coupon, and that coupon stays the same for each payment period. The coupon is generally interest only, and the investor collects principal only when the bond matures, and only at that specific maturity date. Contrast that with mortgage bonds, they carry a monthly coupon. That coupon amount varies each month depending on the prepayment rate on the bond. And the coupon consists of interest and principal, and you're collecting principal incrementally each month. What that means is that as the principal pays down, that amount of interest related to that principal is also changing. And unlike a traditional bond where we have a set maturity date, mortgage bonds also have a set maturity date, but they're analyzed on an average life or duration basis, essentially the average time that the principal is outstanding.
Okay, so you mentioned you thought that current market conditions might be favorable for mortgage-backed securities as compared to traditional corporate bonds and maybe treasuries as well. I don't know. Why don't you tell us a little bit why you feel this might be a good time to consider adding mortgage-backed securities to a diversified portfolio?
Yeah, the big reason is, as we talked about briefly at the beginning, is that interest rates are very low historically. In fact, short-term interest rates, very, very short-term interest rates, are near zero. If you look at Treasury bill rates, let's say inside of 3 months. So the prospect for rising interest rates is more than it is for declining interest rates, assuming that zero is the floor for rates. Now, we've seen in Europe and other places where that is not the case, but the Federal Reserve is committed to keeping a zero or positive interest rate policy rather than allowing interest rates to go negative. So because of the monthly cash flows of mortgage-backed securities, okay, they provide an opportunity for the reinvestor to reinvest more frequently, since you're getting cash flows every month, versus a traditional bond that pays semi-annually. So mortgage-backed securities really are a way for you to kind of hedge against rising interest rates as you're getting these cash flows more frequently.
Got it. So you're it's kind of like you're leveraging in at higher rates because your principal is being repaid gradually rather than as a lump sum at the maturity date.
Spot on. That's exactly the correct way I look at it. Correct.
That makes a lot of sense, Dan. A lot of sense to me. So what are some of the ways you think an individual investor could get exposure to mortgage-backed securities?
Well, it's the famous answer, it depends, right? So I would say for retail investors that may have smaller asset base, and that's all, that's a relative term. I would say exchange traded funds and bond mutual funds are a way to get exposure to the product. I like exchange traded funds just because, from a fee standpoint, et cetera, they're a little more efficient than bond mutual funds. The negatives of ETFs and bond mutual funds is they don't have a maturity date. Okay, so right. Essentially the NAV could, if you buy them at these levels and interest rates rise and the components of the security are such that the NAV could remain at depressed levels for long periods of time, not having a maturity date is a negative. The positive is, as I just said, it allows these retail investors to get into this product in a more efficient manner. The third way to get in is on an individual bond basis. So if your asset base is large enough, I actually prefer this method of individual securities because we can control more of the risk components that drive the return on an individual security basis and incorporate something that we call laddering as a fixed income strategy, which is not possible at the ETF and bond mutual fund level.
At what level do you think people can consider investing in individual mortgage-backed securities? How much would you think an investor might have to have available to be invested before they would be a possible participant in that market?
I would say at least probably 250 to 500,000 dedicated to this specific product. Okay,
right.
I would say if you are, kind of a journeyman type investor or journey person investor where you're investing, a few $1,000s here and there, but you would like to get diversification and exposure to this sector, I would stay with the ETF and the bond mutual funds. But if you're a high net worth or ultra high net worth individual, I strongly suggest looking at the individual bond method than the ETF or bond mutual fund method.
Well, and I share your enthusiasm for investing in individual bonds where you can. The mortgage-backed security market does require a larger contribution to capital than you would take, for example, to invest in treasury bonds, which anybody can virtually do. But I do share, and I've spoken in the past about the fact that, bond ETFs are perpetual maturity date bond ETFs are problematic when interest rates are rising because you don't have a maturity date, you don't have a guaranteed amount. I would think that maybe mortgage-backed security ETFs are a little less vulnerable for the same reason you mentioned a moment ago, and that is that even the principal is going to be repaid periodically, so the ETFs will be laddering it in a sense the portfolio that they hold.
Exactly, and I just want to add that generally speaking, my experience over the last 30 years or so has shown that mortgage-backed securities outperform, provide excess returns when interest rates are stable to rising. They generally underperform when interest rates are falling, as a general rule. So as we discussed, Andy, if you think that interest rates are bound on the lower side by zero, and we're near there on the short end and not too far away on the long end, then I think the market is well suited right now for mortgage-backed securities outperforming, as we believe that interest rates really can't go much lower and potentially could rise due to some of the inflation concerns that are coming out in the market currently.
Well, that observation makes a lot of sense to me because, as interest rates decline, mortgage holders tend to refinance, which means they're going to be repaying their mortgages, and the ETFs that hold those are going to have to reinvest the cash that comes in on new mortgages that have lower interest rates.
That's correct. Yeah, prepayment risk is one of the key drivers of return for mortgage-backed securities, and it's not necessarily a negative. It's a risk we have to manage, and my job as a trader and a strategist is to really come up with solutions where we're looking for outsized returns, or alpha as we use it in our business, for managing that prepayment risk effectively. Remember, you're earning a return on a mortgage-backed security because the timing of the cash flows is somewhat uncertain. And it's how we manage that uncertainty that provides us an opportunity to earn outsized returns, or alpha.
Oh, that sounds great, Dan. Is there let me back up and say, I tend to be I prefer passive index ETFs as compared to actively managed ones in most sectors, but not all, but in most sectors, because history has shown that active management really isn't able to add alpha in a large variety of areas. But maybe mortgage-backed securities is one place where an investor in a bond ETF or MBS ETF might want to look for an active manager. What do you think?
Yeah, I think so. I think there's, one of the things that we use this term moving parts. There's so many moving parts related to mortgage-backed securities that really, to me, it emulates kind of security selection rather than market sector exposure in equities. So these moving parts, as you mentioned, Andy, are the prepayment risk, the extension or the shortening of the duration, the credit quality, the liquidity, the duration of the security. So these four kind of key moving parts are enough out there that good managers in these actively managed ETFs can source alpha, I think, on a highly predictable basis versus a treasury, which is really very few moving parts and very efficiently traded, and it's very difficult to source alpha in treasuries unless you're really making a market bet on the direction of rates.
Well, that makes a lot of sense to me, Dan. Thank you. And before we wrap up here, do you have any other observations about the fixed income market in general outside of mortgage-backed securities that you think would be of interest to our listeners today?
Yeah, I do. One of my big concerns right now is market value fluctuation for the returns that are being offered in the sectors. A couple of brief points. In municipals, a concern is some of the states that are running large deficits via their pension obligations and things like that. So that's a concern. We'll have to see if any of the stimulus gets directed to rectifying those issues. In corporate bonds, because interest rates are so low, corporations have chosen to really change their capital structures up by levering up their corporate bond issuance, so levering up their balance sheets. And one of our concerns is in the corporate sector of the credit risk relative to the returns being earned in corporate bonds may not be the right balance that we're looking for currently. Just in general, the impact of rising interest rates, just to give your listeners a brief example, the 10-year Treasury yields about 1%, a little over 1%. Just to give you some reflection what that means, a 10-year Treasury, if interest rates were to rise 1% relatively quickly, would be a decline in market value of 9%. So if you think about a Sharpe ratio used to measure risk versus return, I'm earning 1% on something, but yet my market value risk is around 9%. And I think that's out of balance right now currently. And we're really looking for solutions, more so in the fixed income market, to sum it up, Andy, that are going to be lower market value fluctuations in a rising rate environment. That may be related to securities like inflation protected securities that the Treasury issues. It may be adjustable rate mortgage securities. It may be traditional mortgage securities that do better in a rising rate environment, or an outperformance versus their benchmarks in a rising rate environment. So the big risk in here is any potential stimulus that's coming here in the next year or two, what its impact is going to be on the fixed income market and what securities we need to be involved in to keep our fixed income allocation the most optimum that we can.
Terrific. Well, Dan, thank you so much for sharing those thoughts with us. And thank you to Piper Sandler Company for making you available for our podcast today. I greatly appreciate it. And thank you all for joining us. Please keep in mind that you should not act on anything you've heard in this podcast until you have discussed it with a qualified financial professional who is familiar with your personal situation and investment objectives. Again, thank you all for joining us, and have yourselves a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.